When it comes to economic studies for mining projects, it isn't an unfair statement to say that not all studies are the same. What we mean by this is that some analysts are heavy on costs while others are less rigorous. Investors that follow the sector religiously likely already have a sense of who is tougher on costs and who isn't without us naming names. Some outfits are known for building mines, while others are better known for producing the numbers that a company wants to be able to better market their equity. Sure, they all fall within national instrument requirements, but those tougher on costs are more focused on being accurate rather than rosy. Which of course means that those more rigorous outfits, while doing their job, tend to make it harder for a project to be sold to the market because the returns don't look as enticing. Which might be the problem that Stllr Gold is facing following the release of their Tower Gold PEA. Let's dive in. Stllr Gold back in May released a preliminary economic assessment alongside an updated resource estimate for their Tower Gold project in Ontario. After talking with the company recently, we learned that the project, while not the main priority for development, remains as a key project and asset for Stllr despite what appears to be mediocre economics. The reason for that is that they are entirely confident in what has been proposed, after hiring G Mining Services, a group with a long history of putting assets into production, to conduct the economic assessment. While countless projects as of late have been subject to major cost overruns, Côté Gold, Greenstone, and Valentine, just to name a few in Canada in recent years, the argument Stllr is proposing here is that while the IRR may appear to be low right now, it is accurate. In other words, other projects may have more favorable IRR figures or NPV values, but those figures go out the window when the shovels begin to hit the dirt and costs explode because of poor modeling. As for Tower not being the number one priority at the moment, we're told that is simply because Stllr has a different asset up their sleeve that has less red tape and can begin generating cash flow sooner, which can then be used to fund the development of Tower. That asset is the Hollinger tailings, which Stllr is hoping to reprocess to extract gold on the cheap as part of a larger plan to get Tower into production. Before we cause too much worry amongst investors, with nearly 11 million ounces indicated and inferred across open pit and underground resources at Tower, the project appears to very much be a priority for Stllr. It's just a matter of this operation being a marathon and not a sprint. Okay, so let's get into what was proposed here. The Tower Gold preliminary economic assessment outlines an operation that would operate for 19 years, producing on average 273,000 ounces of gold a year, with peak annual production of 325,000 ounces occurring in year 15. As is fairly common amongst developers, Stllr is also proposing that a sizable chunk of production occurs up front, with average annual production over the first 5 years estimated at 316,000 ounces. So while not a tier 1 asset by any means despite the amount of gold resources, Tower would still be a large operation in terms of gold mines. Over the life of mine, 5.2 million ounces of gold are expected to be produced, out of that current 11 million ounce resource, meaning that there's some potential for this 19-year life of mine to be basically doubled provided the economics are there. Production is initially to come from the open pit deposits, while underground development will begin after the 30-month construction phase is complete and commercial production begins at the mine. Open pit operations are expected to see a throughput of 2,200 tons of ore a day at an average head grade of 0.75 grams per ton gold and a strip ratio of 6.3. While underground operations will see the production of a more modest 4,700 tons per day at average grades of 2.35 grams per ton gold. The open pit operation is expected to contribute about 175,000 ounces of production a year, while the underground contributes about 98,000 ounces annually. On the processing side of things, the plant is expected to process up to 26,000 tons per day with average recoveries of 92.7%, using conventional milling, gravity concentrating, and leaching circuit to produce doré. Alright, so let's take a look at the dollar and cents side of things, which is where investors seem to have a bit of an issue with this assessment. Initial capex with contingencies is estimated at $1.87 billion. That is, of course, Canadian, but still excessive, especially for a project based in the Timmins region of Ontario and not in a remote region like the Yukon or northern BC. But the infrastructure baked into that assessment is rather over the top and includes a truck shop and related maintenance buildings, site-wide haul roads, a high-voltage transmission line, surface water management ponds, a water treatment plant that we're told is oversized, and a 400-person camp, the latter of which isn't exactly needed in the Timmins region. The initial capex also includes the full upfront purchase of equipment without the use of lease financing. So there's certainly room for items to be reduced or removed in terms of initial capex. But this upfront number, we're told, is all-encompassing. That being said, the largest expense here in terms of initial capital is still open pit mining at $355 million, followed by the processing plant at $265 million and power and electrical at $214 million. Indirect costs also contribute $235 million to the figure, while contingencies account for $246 million. Sustaining capital over the 19-year mine life is estimated at $1.7 billion, which is largely comprised of mining expenses, with $834 million attributed to the underground side of things and $769 million attributed to the open pit operation. In terms of unit costs, total cash costs over the life of mine are estimated at $12.80 US an ounce, which places the operation in the middle of the pack in terms of mines, while AISC is estimated a bit higher at $15.37 US an ounce. All of this ultimately translates to an after-tax net present value of $1.4 billion Canadian and an IRR of 13.4% based on $2,500 an ounce gold and a 5% discount rate, with the payback period estimated at 5.8 years. At $3,200 an ounce gold, the NPV jumps to $3.3 billion, while the IRR climbs to 24%. And that payback period falls to a more digestible 2.9 years. All right, so let's wrap it up. Provided the price of gold maintains current pricing, Tower looks like a project that will likely be developed. With 11 million ounces in a resource, we're certain there is some way to economically develop it. But if we're being honest, at $2,400 gold, it isn't really all that enticing with that estimated IRR. That being said, Stllr looks to be moving full steam ahead, with the PEA, as per Stllr, expected to form the basis for the project notice and project description required for provincial and federal permitting processes for Tower, including the impact assessment. While that is ongoing, a pre-feasibility study is expected to be delivered in the next 24 months, with work having already begun for that study. An impact assessment is expected to be submitted within 30 months' time, and a feasibility study is meanwhile expected within the next 36 to 48 months, which sounds like kind of a long time. But hey, nobody said going from exploration to production was a fast process. That's for sure. All right, everybody, thanks for watching. As always, if there's stories you want us to cover, please let me know in the comments section. Also, if you want some more mining content, don't be afraid to check out the rest of the videos on our channel, or head on over to our website, thedeepdive.ca. All right, everybody, if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.